thank you for being here. So today I want to talk about a case-based study on robo-advisory efficiency. And just to let you know a bit of my background is, unlike most academic people who start academia and then go to entrepreneurship, I went backwards. I co-founded a company in Mexico when I just graduated. And then I decided to go into academia and research about what I was doing. So I started actually really getting interested about a lot of those questions that were coming through the way, because the company that we co-founded is a robo-advisor. It's one of the first in Mexico. And we had a lot of questions about it. How do we measure performance attribution? How do we profile customers? How we actually automatize algorithms and so on. So yeah, one of those questions were in terms of return. So we all know that we are having a huge double-digit growth of robo-advisory solutions, automated solutions, and the questions, some of those unsolved questions are: how are we going to measure them? And for example, who's going to be, guilty if something goes wrong? Who is making those portfolios? Is it truly a robot, or is it half a people, half an algorithm? Who is to be held accountable for? And how we will measure them, basically, how we will find metrics about them. So more specifically, my research question was like, are robo-advisors efficient compared to fixed weight ETF composites? I'll tell you in a minute why I came up with that comparison, or are they efficient based on the domestic fund market anyway? So we found out in the way that first of all, before starting with the return decomposition and so on, we found out that it was first a semantical problem, like what is robo-advisors and how do we classify them and how we group them and what are the components of the robo-advisors. So first of all, we had to do some semantical work. We had to come up with a specific definition. Then there's of course a limited amount of data, and the robo-advisor I was working with was just too new to rate, right? So that was too new to have data. So I took a robo-advisor that went public in Japan in 2021. I think now was acquired last year, I guess. So it was a very successful success case. I can always share the data set and everything, and then we tried to decompose the return. So basically, what we came up with is, after this definition problem, it turns out that robo-advisors are not active nor passive, right? They cannot be passive because they are not purely indexes, and they cannot be active because they are not actively managed. So we did a return decomposition between a tactical, which is the rebalancing part of the portfolio, and the strategical part, which is the initial selection of the portfolios of the robo-advisor. And then we measured this test again, the fixed weight composite. I will in a minute explain what was that, and then and more easily with the Japan fund market aggregates for the strategical part of the portfolio. Yes. So back to the classification, we screened back then around 140 companies that they had in their, and this was worldwide, that they have in their offer the so-called robo-advisory, right? So we tried to come up with the main components of what was that, what is a robo-advisory, what they refer to. Some of them are very explanatory, some of them offer white papers. And most of them basically are based or relied on MBO optimizations, some of them like Litterman or factorial models. It is a trend that most of them, if not all of them, they use ETFs as means to diversify the portfolios. And they are goal-based invested, but they are not specific. they are basically bucket assigned, right? Most of robo-advisors do not give you a specific portfolio, but rather they just assign you into a bucket, and then that bucket, it's supposed to work for you. So most of them do not do active trading or investment. They don't take specific names. They don't go short. They basically take indexes, they pack them into a portfolio, and then they just leave it there. But one of the characteristics is that they do rebalance, right? Which is after a couple of months, after a couple of periods, they start doing a rebalancing period. Of course, the dynamics of how they choose those ETFs, they don't show them, and all of them have their own proprietary models, right? And on the rebalancing, of course, there's also not a specific rebalancing methodology. Some of them do explain, some of them don't, right? So these are the key takeaways from there. Common traits, and of course the bottom line, which is they are not purely passive and they are not fully active. So again, the question is how we attribute performance. So here's the case and the data. So there's a robo-advisor in Japan called Wealth Navy. It published a data set on the returns of his portfolios. And also it offers Japanese white paper. So I had to do some translation, which is not easy from Japanese. So they offer a white paper where they explain a little bit of their methodology. They explain their investment universe, and they also set their initial portfolio weights. So that was a very good starting point to actually decide whether, to actually understand what was the strategic allocations, right? As per their white paper, they use MBO and constraints not specified. So this is the 5 risk profiles that they do. So this is they have 5 portfolios, 5 buckets of risk. They have this, you will see the portfolio weights for each of the portfolio buckets and risks. And how we did the experiment, we basically constructed a composite using such weights, right? And the 2 questions that we had was, how can we decompose the risk? Therefore, first question was, what if a person who does not get that robo-advisory just takes this weights and just invest them and don't touch them ever? So with that part, we were trying to measure, how good the robo-advisor was at rebalancing, and the other part was comparing against what if the person who wanted to invest would just go into the Japanese market or into the Japanese market and take any mutual fund that aligns with those profile risks. And just so you know, I'm talking about Japanese market, but of course the mutual funds that are listed, most of them have the same name. So we wanted to make sure that they were actually touching the same names into the portfolio allocations. So we create a buy and hold fixed weight portfolios using the robo-advisor initial weight. We did some normalization based on the currency. We can structure, the rationale is like if the investor basically cloned the initial weights, how would have that ended up, right? And the other rationale is like, what if they would just have gone into what if they have just go long into the Japanese average mutual fund that offered the same level of risk and the same exposure that the robo-advisor. So just a huge spoiler alert, and we just finished early. It's just that the results are non-significant. So basically, so we don't have any increased volatility nor increased return. We don't have any abnormal return on the portfolios. We basically the results basically show that on terms of risk and returns, the portfolios are actually efficient we also we did some visualizations, which of course they are in terms of these are, sorry for the small letters, but basically this is the benchmark of the portfolios, and this is these are the real returns of the Robo advisory. You can see they are pair on pair, like 1-to-1, exactly almost the same.
Sorry.
Yep.
So your benchmark outside the robots is not rebalancing, or is rebalancing?
Benchmark outside the Robo advisory weights is rebalancing, because it's just this is the Japanese fund market benchmark. The other is not rebalancing, right?
It's not rebalancing, and that's rebalancing.
Exactly. This is rebalancing. This is not rebalancing, which looks almost identical, right? You will see that the so-called tactical rebalancing of the Robo advisors, it might not even be tactical, might not even have that tactical component. Of course, there are some differences, but they are very, very minor, right? In terms of volatility, they are, again, one-on-one. Tracking error, of course, gets higher because of the rebalancing differences. But of course, they also go similar one-on-one. So the results is basically there is no outperformance. There's no evidence of the outperformance of the Robo advisors on a buy and hold composite basis, and there is which leads to limited tactical alpha, if we want to put it in that way. I don't know if this might be the right word to say it, but yes, there is no tactical rebalancing that makes a better outcome. Right. Then if I had just bought those same shares with those same initial fixed weights and not touch it at all, right? And there's no significant variance difference as well. And there is no strategical. The strategical component that we talked about is basically the differences between the mean returns of the market portfolio, which is the Japanese fund market portfolio, and the factual returns of the Robo advisor. So for that one, we also didn't find any significant mean differences. So we basically found also that there is a limited strategical alpha. That means that there is no significant outperformance on that side either. So the results are quite. They were initially for me quite disappointing, because I was a huge enthusiast about Robo advisory, but it just turns out that they are just as efficient as the market is, and it turns that they just in the tactical side they have very limited capabilities or almost non-existent rebalancing power. And on the strategical side, they are just the market portfolio. In this specific case, we just generalize with this specific case, and yeah. Yep.
So is it just the robot in the white paper? They promise that they will be doing that strategic and tactical.
Yep.
Who is holding them accountable? Like, are you sure they're doing it?
We don't know, and that's one of the questions for even for regulators out here. Like how we hold them accountable. How actually we what are the metrics for them, and how they will how they are promising, or what they are promising, what they are not promising, and how they are measuring that promises, right? Yeah, go.
This is probably outside the scope of your paper, but just thinking out loud.
Yeah.
Do you think this will actually possibly change if the composition of the portfolio is different? I'm assuming most of these are large cap stocks.
Right.
If you looked at a different market and more mid cap or probably much smaller public companies, I wonder if the performance difference would actually be a little bit more noticeable. Just a question. I don't know the answer, but I'm just wondering.
It might be. Yeah, it might be, because after we performed this search, we kept looking for upcoming Robo advisors in the market, and we kept looking at what were their holdings and how they were assigning such holdings. So probably the strategic allocation is changing, but honestly, the names that we saw there, 3 of them or 4 of them are actually constant. Wait, I probably lost it somewhere here. So 3 or 4 of these names are constant in most of the robo advisors we have, at least have access to their holdings, right? So for example, also, if we take a look to Revolut robo advisor, they have a not exactly the same name because it's the European market, but they have the counterparty of one of those names, which is basically the world index, American index, and emerging market index. So some of them are just constant. Yes.
Yes. To which extent there was rebalancing the portfolio when using the Robo advisor? It was often, or
we cannot. That is a good question. We cannot know because we just have monthly return data, but we infer that that there was monthly rebalancing because we can see differences in the weights throughout the time. So yeah. So yeah, basically there might be a monthly rebalancing process.
Did you try to replicate? I mean, what was so when you say tactical rebalancing, what does it mean? It means that you're maintaining sharp rate. You're trying to maintain sharp ratio, or you're trying to.
That's exactly something we don't know. So we tried to replicate with we just reround the MBO optimization. On our benchmark composite, and it does not match. So we thought they just have this tactical rebalancing methodology that they don't share. They just basically show the initial fixed weights, and they share that they do use MBO optimizations, but we don't know by which mechanics they do rebalance, right? Yep.
And the level of investment.
The level of what?
You measure the returns of the whole portfolio?
Yes.
But there was cash, or how much they invested, the fund was invested 95% of?
Oh,
it was,
we don't know also because they only post return data. So we don't know actually the assets under management nor the amount of those assets under management invested, but that's a good question. Sorry, there was one question back there. Yeah.
Just one question about the monthly rebalancing. To me, that seems quite often.
Yeah.
Do you have any insight about transaction costs that this causes?
Yeah.
Does this have an impact?
Yeah, they do not mention that, so that could be a good component to add into the equation. Yeah. One more question.
I just wanted you didn't mention the risk aversion. So it could be that this portfolio you constructed is market neutral.
Right.
And automatically would track the market.
Right.
If you'd chosen something, a hypothetical investor with higher, lower risk aversion would diverge.
Yes.
I would have thought.
Yes. Well, they probably use the same scale than most of robo advisory, which they just go from 1 to 5, where 5 is the most risky one, which is the one that is mostly invested into equities. Less of the other. Yeah, you can see here low investments into bond ETFs. So yeah, they don't mention what is they also don't mention the risk aversion methodology or their utility mechanism, the utility function or the mechanisms by which they assign those. They just say that we have 5 buckets. 5 risks and that's it. And yeah, this is one of the questions we're trying to address into the other forum.
Would be hyper protective of that.
Yeah.
I wonder whether you could reverse engineer that, because when you open an account,
right,
they would ask these questions, trying to get a risk profile
on
you. So you could pretend to open an account.
Yes, and go there.
Get those questions and sort of.
Yeah, we try, but they are also protective of that because you need to log in with your Japanese back then also your Japanese ID and everything. So
That's a Japanese call.
I'm open to offers if somebody knows anyway.
That's a fair point, because a lot of these robo advisors have some limits in terms of a bit of risk tolerance, etc.
Right.
So you can't actually deviate beyond that. So
Yes.
the only way for you to explore, if outside of those risk boundaries, if you want to compare them with these, passive funds, etc., is to probably think about some kind of simulation.
Yeah.
It doesn't have to be, it doesn't have to be an active robo-advisory app, but if you run a simulation with a portfolio, and then how the robo-advisor will actually potentially advise, and then so you're not actually putting in your money, but then running a simulation exercise to do the comparison.
Yeah.
Because right now, regulation prevents you from kind of getting beyond certain boundaries, and probably that's why the returns are also similar. Which kind of goes back to my point. If you change the composition to include more risky things in your portfolio, I don't know if there's going to be more divergence.
Yeah, there might be. Yeah, definitely.
Can I ask from a practical point of view, this robo-advising, they're using what the response to the questionnaire by the
yes.
They are not looking to the behavioral patterns of the clients. Like
correct.
No?
They are not. Yes. Yeah, yes, and that's in the other forum where we were actually discussing. We might talk about it later. It's like another big problem is this questionnaires also come back from a seminal paper back in 1999, and all of the robot advisors are making exactly the same questions in terms of what is your experience, what assets you have traded in the past, and so on and so forth. So basically, there's a huge there's a huge inaccuracy on how these risk levels are measured, and there's a huge disconnection between the real behavioral components of the risk profile and the actual portfolios that are there. So that's an interesting topic for discussion as well. All right, so I don't think I had anything else. Just talking about some limitations. Of course, we have survivorship bias in the Japanese fund benchmarks. We have the rebalancing rules are not fully disclosed, so that's that we address that. We might need to consider other factors that are not explicit in modeling, which is the fee netting, tax considerations, and of course client behavior. We basically one of those questions. So that's it from me. Thank you.